What's up, traders? Steven here, your honest trading coach, and today I want to show you a strategy that since 2015 has not lost one of its trades. I'm talking a 100% winning percentage since 2015, and then I'm going to tell you why you should not necessarily be trading that strategy. I know it sounds confusing now, but I promise by the end of the video, you're going to completely understand what I'm saying. And I'm also going to show you a strategy that has about a 70% chance to win that you are much more likely to make money on. And I'm going to give you the reasons why. So if that sounds like something that'll be interesting for you, go ahead and click that like button to help out with the YouTube algorithm. Go ahead and subscribe because we come out with content like this each and every week. Make sure to click that notification bell so you're notified when we do so. And go ahead and follow us over on Instagram at The Trading Channel for more content. And I'll be right back to share with you a strategy that's won 100% of its trades since 2015. See you in a second. Welcome back, guys. The first thing we're going to do is dive into the strategy itself, and I'm going to teach you the strategy that's won every single trade that it's had since actually 2005. I was mistaken in the intro. It's since 2005. As you can see, we are on the New Zealand yen chart. We're on the daily chart, and we're at 7/11 of 05. I'm just going to teach you the strategy because it will take less than 60 seconds. It's super simple. I call it the 100-200 strategy. What I'm looking for with this strategy is 100 candles. 100 bars that have not touched the 200 period moving average. Black line is 200 EMA, which stands for exponential moving average. Price, the bars are the bars, right? We need 100 bars that did not touch the 200 EMA. That's condition number one for this strategy. And in case you're wondering if I count every single bar, I do not. If you have a ruler tool like I do here on TradingView, it's right here. This tool will let you count bars or pips up and down. It lets me count bars, so I just grab the latest bar before the touch of the 200, scroll back until I have 100 bars. And if out of that 100 bars, we have not touched the 200 period moving average, then I know my rule is met. So first two rules are already there. The next thing we're waiting on is a touch of the 200 EMA, either that touch being with a wick or the body of a candle. So going back, we have 100 bars that have not touched the 200 EMA. We then have a test of the 200 EMA, and our entry reason is a close above candle, which only means we have a candle that closes above the high of the previous candle, like you can see right here. So that was our entry reason on this specific trade. Now, the context of this strategy is very simple to understand. If we've been above the 200 period moving average for 100 days, in this case, for 100 bars, then we're in an uptrend, right? We're in an uptrend. There's no doubt about it. And what we're waiting on is a very deep retracement of that uptrend to hit the 200 EMA, and we're buying a close above candle off of that. Since 2005, this strategy has not lost here on the New Zealand yen, but there's a big part of strategies that almost no one thinks of. I didn't think of when I was starting out my trading career, and that's something we're going to talk about in just a second. Let's go through the trades we've had since 2005 on the New Zealand yen, and let's see if you notice the reason that even though this strategy has won 100% of its trades since 05, see if you can spot the reason that we don't necessarily need to try to trade this strategy. So let's go ahead and move the chart forward. Here we have another situation. We can count all these bars. I'll do this one more time with you. We have 100 bars. We actually have 100 and right at 14 bars, as you can see right here. This means we have 114 bars from the bar I started on, that little green candle, to this red candle, the bar I ended on. So at 114 bars, that's over 100 bars that have not touched the 200 EMA at all. No wicks have touched it, nothing. Then I'm waiting on what? A test of the 200 EMA, and after a test of the 200 EMA, I want to see a candle that closes above the high of the previous candle. In this case, we have all those rules met. This would be another winning trade. Now I'm going to scroll out and speed this process up just by showing you the trades and not talking you through them. No close below candle here, even though we did have 100 bars below the 200 EMA. Here we had an entry because we have 100 bars above the 200 EMA, and we have a close above candle right here. My green line is on one. So if I scroll the chart out and we move forward, you can see that we had a few other instances, and right about now, we're on today's date. Can you tell me a problem with this strategy? This is again a part of strategy development that most beginners don't think of. And don't worry, I'm not just leaving you with this. I'm going to show you a strategy that happens a lot more and still has a decent winning rate, right? That kind of gave it away. And decent winning rate, the strategy I'm going to show you next, is actually one that wins around 70% of the time, but has many more instances that it happens. At this point, I've completely given it away. If you look at this chart, we have 1, 2, 3, 4, 5, 6, 7. We have 7 trades since 2005. So although you might have a strategy that's going to win at a very high win rate, let's say 80 and above, the chances of you hitting a strategy or finding a strategy, developing one, learning one from someone else that has a winning percentage over 80% and produces enough trades throughout time to be relevant at all is so small that doesn't really exist, because the more accuracy a trading strategy has, most of the time, the smaller amount of frequency that trading strategy happens. So in this case, the part of strategy development that was not considered, although at first glance, a 100% accurate trading strategy since 2005 sounds like something you should trade every time, right? But the variable that was not considered in this case is frequency. Frequency of a trading strategy is just as important as everything else. If you have a strategy that wins 100% of the time but only has 7 trades, that's not as good as having a strategy that's only 60% accurate, but instead of 7 trades, it has 50. You see what I'm saying? So that's something, that was the main lesson of this video that I wanted to teach you, was that you always want to pay attention to frequency. And I also want to show you a few ways that you can counter this. So with this strategy only having 7 trades throughout 15 years, what can you do? Well, you can trade it on 20 currency pairs. You could test this on 20 different currency pairs. If it performs similar and you had a 90% win rate with a few more trades, maybe it's worth it then. You could try this on smaller time frames to see if it happens more often on smaller time frames. Those are some of the ways that you can counter the fact that this only has 7 trades in 15 years. But overall, what you're going to find is this is just a strategy that does not happen enough for the excellent winning percentage to matter. And that's something you don't want to run into in strategy development. As I said, let's call it 7 trades. We're going to do some math now because we're about to look at the other strategy that has about a 70% accuracy, but way more trades. So let's do some math. You win 7 trades in 15 years. Let's say you risk a high amount, and that's 3%. 3% divided by our 15 years, you're literally making 1.4% a year. You're better off in the S&P 500, which averages somewhere closer to 8% per year. So that makes absolutely no sense to do, right? Now, let's dive into a strategy on the Aussie Canada that's had many more trades and one at about a 70% accuracy. Let me teach you this strategy. So first off, let's talk about the strategy. This is something I would actually suggest testing on smaller time frames. I haven't personally done it yet, but I plan to start testing this on smaller time frames just to see what I come up with. And just so you know, I spend about an hour to 2 hours a day doing nothing but testing strategies. That's the reason you see me come out with new strategies almost on a every other week basis here on YouTube, because I find something that works and I want to share it with you. So in this case, what is it that worked? Here on the Aussie Canada, we're on the daily chart. We're starting back at 2005 again. But in this case, our strategy is nothing more. You don't like, this is going to be so freaking simple. Is nothing more than 2 wicks coming off of the 200 EMA to the correct direction, right? So if I have a wick and a close above the EMA, the 200 EMA is all this black line is, then I have a wick and another close above this 200 EMA. Both of these wicks have touched the EMA. Both of these closes are above the EMA. Then I place a buy trade that looks something like this. And I have my stop at around 1 ATR plus 20, I think is what I did here, which would look something like that. And I had a max risk reward of 1.5 on these trades. But let's check out the results and tell me, would you rather trade this at 70% accurate or the other strategy we took a look at 100% accurate? Let's take a look at a few of these. So if we scroll through here, I'm just going to show you a few other examples of this. Here we had a losing trade that was based on the same exact thing. We have 2 wicks coming off the 200 EMA, the body of the candle closes. Below it, this only got to about a 1-to-1, but I'm looking for a 1.5 out of these trades, okay? The next situation that we have, look right here. These bodies are touching, the wicks are the only thing that can touch the 200 AMA. These bodies close below it. So that's not an example of a trade I would take. Nothing else is until right here. One wick off the 200 EMA, 2 wicks off the 200 EMA, both candles closing below the 200 EMA, and the bodies of the candles not touching it. There I have a short example. As you can see, pushing down, this would have hit targets easily at a 1.5 to 1. So that's what every one of these trades is based on, and let's count them up. You're not gonna have to count them with me. I'll just count them, edit this part out, and you'll have to just trust me. You can pause the video if you want to and check these trades. But the results I came up with for this specific strategy were, I'll give it to you in 3, 2, 1. 42 total trades, 28 of those trades being wins, 14 of those trades being losses. 42 trades over 15 years, I get it. That's not a huge amount of trades either, but it's much better than 7 trades at 100%. Remember what that was. That was 21% over 15 years. If I'm not mistaken, it was like 1.4% a year. Well, what does this 42 trades give us? We have 28 wins at a 1.5 to 1 risk reward in this case, which gives us 42. 42 minus our 14 losses gives us 28. Remember the last strategy, we talked about a 3% risk. So let's do a 3% risk here too. That's 84% in the last 15 years, divided by 15. Now you're getting closer. And this is the beauty of this, is that what if you had 10 pairs that you were doing this with? Okay, 10 pairs at this rate, 5.6% a year times 10 pairs turns into more like 56% a year. Now, I don't know what you made last year or what it's looking like you're going to make this year, but 56% is a really good return, especially if you're only having to look at charts one time a day, because these trades are based on daily charts, and you're trading a strategy this simple on 10 different currency pairs. That would take you no time to look at charts, and it could give you up to a 56% gain, or at least it has in the past. Of course, it's not a guarantee that this will happen in the future, but this is all we have to go on in terms of what we're going to be trading. And it gives a high likelihood that the market will react in a similar way over the next 15 years with how long of a span of time we have using this strategy. So 56%, let's look at what our 100% winning strategy would have done. We had a 1.4% per year. Even if we had 10 pairs, you're only looking at 14% a year. So either way you slice it, if you will, you're much better off trading a strategy that has a lower win rate and a higher frequency rather than a higher win rate and a lower frequency. Now, of course, this was extremes. And the only time this applies is in extremes, when you have like 7 trades on one strategy and 40 on another. But that's something that you need to consider when you're testing, developing strategies, and when you're learning strategies from other people, is consider the frequency of the strategy. 100% accurate doesn't mean shit if it's only had 7 trades in the last 15 years. Whereas you can have a strategy, in our case just a second ago, that would be 28 over 42 total trades, only 67% accurate, but made so much more money over a long period of time. Instead of making 14% a year, that strategy over the past 15 years has made 56% a year, assuming, of course, that you have 10 pairs that perform in a similar way. Hopefully none of that went over your head. This is something I think about every single day. So if that got confusing, I am really sorry. I hope it didn't though. And if it did, go back and rewatch it a couple of times. I'm sure it will start to make sense. But with that said, I hope this video taught you the lesson that I was trying to get across, which is always pay attention to that third factor of a strategy. We always have 2 factors that almost everyone thinks of: win rate and risk reward. But don't leave out the redheaded stepchild. Don't leave out frequency. Frequency is just as important as the other 2, and you want to make sure you're trading a strategy that happens frequent enough for it to matter and for you to make money on. So that being the case, if you enjoyed the video, click that like button. If you're interested in some more free training, we have a full strategy listed below, full strategy free training in the description. We also just opened up a brand new case study group into our advanced mentoring program called the EAP. If you're interested in that, it's the top link in the description. In that program, there's a full training course going over the strategies I use on a day-to-day basis You'll also be receiving 3 to 5 emails per week of trades that I'm taking based on the strategies you learned in that course. We have risk management training, discipline training, and obviously it's a mentor program. So any questions you have, it will be me you're talking to directly and me responding to those questions for you to help you along your trading path to accomplishing your trading goals. So if that sounds like something you're interested in, top link in the description labeled EAP. If not, that's totally fine too. Just make sure that you are subscribed, that you've clicked that notification bell so that you're alerted about this interesting content we come out with each and every week. Hope you guys trade green, and I'll talk to you in the next video. See you soon.